Good afternoon. Welcome to the ACT's webinar on Brexit. I'm Michelle Price, Associate Policy and Technical Director here at the ACT. Today I'm joined by two excellent panellists. Stephen Powell, a partner at Slaughter and May, who also sits on the ACT's Policy and Technical Committee, and Naresh Agarwal, a Senior Manager at PwC within their specialist Brexit consulting team. Just a few housekeeping points to start with. The console is interactive. You can move around the applications on your screen and minimise and maximise them. You can anonymously ask questions throughout the webinar by clicking on the Q&A box next to the media window. We do plan to have a Q&A session at the end. If you have any technical questions, you can type this into the help icon. So let's get started. Brexit is and has been a political shock. While there are many long-term legal, constitutional and macroeconomic repercussions because of Brexit, most of what has been said in the press and online is speculative in nature. We don't know until discussions and negotiations have at least started, let alone concluded. But we've seen an immediate impact on the economy. We've seen a flight from riskier assets, sterling and equity, to safer assets such as gold, government bonds, and even US dollars. These and others have had an immediate impact on corporate treasurers. Let's start by making sure we all understand the legal process for a Brexit. Stephen, can you please give us a brief overview of how the UK will leave the EU and any thoughts you might have on timing?
Certainly, Michelle. First point, as we all know, the referendum was not legally binding, but David Cameron's government has said, and indeed every politician seems to be echoing this, that they will follow the results of the referendum. The process is to serve a notice under Article 50 of the Treaty on European Union. That gets served on the Commission. There is then a waiting period and a negotiating period for a withdrawal agreement for the UK to withdraw from the European Union. That period will last either until an agreement is concluded or for a period of 2 years, or finally, if everybody agrees, some extended period beyond the 2 years. When will that notice be delivered? Unclear at the moment. David Cameron has very clearly said he will leave it to his successor. The question then comes, who wins the Conservatives' elections that start today, I believe.
And Stephen, once Article 50 is served, or when the 2-year period is up, is EU law effectively dead for UK banks and corporates?
Well, I think from a technical point of view, yes, there will be any direct effect that EU law has on the UK will cease. However, there will be many, many things where the UK will, I'm sure, want to adopt something pretty similar to EU law in so many different areas, and so many different areas relevant to corporate treasurers.
And when will deregulation happen?
Well, that's the big question. Will there be any deregulation? And again, coming back to the areas that corporate treasurers are focused on, so many of the decisions that we see coming from the EU were actually decisions that were taken at the G20 level. And so the UK government, as a member of the G20, will want to comply with that in any event. An example there is EMIR. So the idea of having derivatives done through a third party on an exchange would be something that I think the UK government will bring into effect in due course in any event. And indeed, if you want to operate cross borders, you will need it because other people want equivalence with their regime.
So EMIR won't necessarily die in 2 years' time?
I'm afraid not.
Excellent. Thank you, Stephen. Moving on to FX and cash management. Last Thursday, the ACT conducted a poll amongst their Treasurers Forum, and the question that we put to our forum was, what are the biggest Brexit concerns that you and your Treasury team will be focusing on in the short term? And we define short term as from now until the end of the year. And not unexpectedly, but the number one concern was foreign exchange volatility and the weakness in exchange rates. Naresh, could you give us a brief overview of what you've seen or what you've heard amongst corporates in relation to FX and cash liquidity, and what should corporates be doing about these issues in the very short term, say over the next month?
Thanks, Michelle. And maybe I can start at a sort of slightly higher level and talk about what we're seeing happening in the market. So talking to some of my colleagues in the banking market, they've identified spreads widening. Someone told me on the day of the vote on the Friday, spreads were 10 times the size they are typically. And whilst it's gone down, I think it's now around 2 or 3 times, it's very clear that the operating of the market is not as liquid as it used to be. And you also get a sense that some of the smaller players are withdrawing from the market, not providing as much pricing. So we're seeing more activity concentrated around big, larger global banks, and maybe banks that aren't domiciled in the UK. So we're definitely seeing a change in and disruption to the operation of the FX markets. From a liquidity perspective, I guess with Mark Carney's news, the markets are awash with liquidity. He's very keen to make sure that's not a challenge for banks and therefore for corporates as well. And then from a funding perspective, I guess there's a tale of two types of companies. For those that are regular issuers, we definitely hear that they are still issuing. In fact, one company issued last week, I think it was 3 times oversubscribed. So you get the sense that with interest rates and long-term rates lower than they have been for a very, very long time, it's a good time to issue if you're part of a regular program.
So was that a regular or an irregular issuer?
That was a regular issuer, where you get people issuing on an infrequent basis. The sense from talking to some of the banks was very much that it may look like desperation, although rates are very low. Given the uncertainty in the markets at the moment, it may not be a great time from perception and reputation-wise to be issuing debt.
What's that looking like you haven't done your homework?
I think so. I mean, that's definitely a good point. And maybe it goes back to a point around how much planning people have really made. So again, talking to a lot of corporates, you get the sense they've all done Brexit checklists. I know the ACT have come up with their own checklist of what to do in the event of a vote. But I wonder how many people really felt the vote was going to go to Brexit rather than Remain, and the depth and quality of their analysis and preparation. And when we look then at how organisations are responding from an FX perspective, I think there are 2 key drivers. One is just how robust the planning has been, and secondly, how well developed and mature their own approach to FX risk management is. So for organisations that are well organised, they understand risk appetite, they've approached the right framework, they prepared for a 15% fall in FX rates. Talking to Treasury on that Friday, he said it's business as usual. The markets, we've operated within a framework, we've got enough, our risk and solvency are where we expect it to be, it's within our tolerance ranges. We've got the right MI showing where we are, we've got the right line to the bank. So if the organisation's doing that, you could argue this is really just part of business disruption and making sure they've got continuity plans in place. But for those that really just scratched the surface around a checklist approach, or for those that didn't really understand where the risks were arising, definitely get the sense that they've really been scrambling around trying to work out what to do. I know, again, talking to one of the treasurers I speak to regularly, he said it's been a very, very long week. They've put in long evenings, weekends as well, trying to understand where the risks have arisen, trying to communicate to the board, provide regular updates, using disparate systems, trying to pull together overall risk framework. So really trying to make it up on the hoof as the markets continue to move as well. So definitely a lot of challenges for those that weren't really properly prepared. In terms of things that they should be doing, we hear a lot around talking about risk appetite, resetting and seeing if it's still appropriate for where markets currently are. We've seen a number of them looking at their hedging strategy and seeing if it's still appropriate. Some of the smaller risks that didn't feature on the risk appetite are becoming more prevalent. And talking to the regulator, they're already looking at how well your business could support an extra 15% movement in sterling based on today's exchange rates. So the regulator is looking not just at what's happened today, but is your business able to withstand a further shock? And I'm sure Stephen will come on to it later. But we haven't seen the last of the shocks to our financial markets. There's going to be more to come. So it's not just have I got through the last week, but it's also am I ready for what may happen in the future. So that's the sort of story you see happening on the FX markets. On the cash and liquidity, I've not come across anyone that's got any real challenges from a liquidity perspective. And it may be because it's too early to tell. We know, I think from the survey done T-7, that a lot of organisations have been hoarding cash, building up, not just because of central vote, but generally because there's not a lot you can do with the money at the moment. Rates are very low. The uncertainty surrounding Brexit meant people didn't want to invest. So I think a lot of organisations currently are sitting on quite large piles of cash. It may be that over the next few months that starts to hemorrhage. So it's really about being mindful around that. We also know for those that are operating as NFC plus organisations, collateral calls with huge amount of volatility in FX markets are creating big swings both out and in. I put over the Treasury this morning. They've been awash with cash as some of their FX positions have been paying money back to them. So
nice position to be in.
He's really got a lot of cash. He's got even more. So what we're seeing people doing at the moment is they're doing a renewed focus on cash forecasting. So is it giving the right insight and intel to senior management? And we're back to daily liquidity management. I mean, when we had the crisis in 2008, I know many organisations were having to report on daily cash positions, not just in the UK, but overseas and variations on liquidity. So we're back to having to produce a lot of daily information to senior management. So that's what we see happening. In terms of what people are doing in the medium term, definitely reviewing their assumptions around cash forecasting and working capital. What strains could you have if suppliers start to want payment up front? What do you do if customers start to delay payments? How much liquidity can you absorb in that working capital? And we see lots of organisations with liquidity, and again, part of what they need to do is find some diversification around those different types of instruments, whether money market funds, depots, or repos. So there's definitely going to be more effort invested around looking at those alternatives.
That ties nicely onto our next topic on counterparty risk. So, as you said, Naresh, these corporate treasurers will have a lot of excess cash at the moment. Interestingly enough, our Brexit T+7 poll last week showed counterparty risk as the second biggest concern amongst corporate treasurers at the moment. So in terms of this increased counterparty risks for banks and financial counterparties, what should treasurers be thinking about here?
So, I mean, that's a great question. And I think that having just seen the UK downgraded by 2 notches, a lot of our banks now on credit, on negative outlook as well. We're going to see a lot more changes around credit ratings and separation between UK banks, European banks, and banks that are broadly outside of the UK. So maybe they're US, Canadian, or Far Eastern-based banks. So we're going to see a greater divergence around those banks. So for corporates, I think they need to make sure they can manage that. So looking at their counterparty risk analysis, many are still relying on purely looking at credit ratings. We know there's a greater interest around looking at a variety of measures, whether it's looking at bank size, where it's located, what business it operates, its share price volatility. So we know there are organisations building more complex models to get a better understanding of the resilience of their key banking partners. We know also people are looking further afield for sovereign risk and sort of corporate risk in terms of financial institutions. So a greater interest around Canadian, US, Far Eastern banks again. So we see a greater move towards investing and having relationships with non-UK and European-based institutions. So I think organisations need to look more deeply at how they manage and monitor counterparty risk and have systems to be able to report on those, because if they do start to change, it's going to start to change very quickly.
Excellent.
Michelle, if I can just interrupt that as well. I think the other aspect of looking at your counterparties is going to be, what is my counterparty able to do from a regulatory point of view? And that position is changing.
Yes,
and will continue to change.
Okay, another topic that keeps arising is funding. We know many treasurers have prepared by funding early and funding long, but there seems to be a lot of nervousness in the press about this topic. Stephen, perhaps you could talk about the impact of Brexit on lenders. We've heard in the press about banks and other financial firms relying on EU passporting. What is this, and what is the impact on corporates if the UK loses these so-called passporting rights?
Just take a step back for a moment. The banks in the UK are ahead of all corporates, in my experience, in that they have done some preparation for Brexit in the lead up to the referendum. One of the things that they've been focusing on is their ability to use their authorization to carry on a particular type of business in one EU country, to then passport that into another EU country using a really very simplified regime which does not involve having to get regulated in the second country. And it's that passporting that banks have been looking at. It's a very complicated position because there are things in different countries. There are some things that need to be regulated that will be different in other countries. So what I do in the UK, maybe I need regulation for it, maybe I don't. Do I need that regulation in France? Do I need it in Germany? Is a question that each bank is looking at separately and for its own purposes. What is the impact on corporates? To come back to your question, I think there is no direct impact, but it is very important, and I've come back to the point I was making earlier, very important for corporates to understand what businesses their banks, their relationship banks, are able to do in the countries that you are interested in. And that is going to be quite a complicated position going forward. And I think it ought to be part of the counterparty analysis that Naresh was referring to earlier.
So corporate treasurers should be talking now to the banks?
I think there's no bad thing about talking now to their banks, because their banks will have done some thinking about this.
Okay.
But continue that conversation. Weave it into the things you talk about with your relationship banks.
Excellent. And for debt holders, does it matter where they are located?
I think that will be a function of many factors that we just don't really know at the moment. So a function of tax treatment, of regulatory treatment, and frankly, a function of sentiment, I think. And sentiment has clearly been very important in the last week or so. That's going to continue, and is something that people need to keep a close eye on.
And more broadly, do you envisage a change in sources of funding and the impact of the downgrade of the UK on funding sources?
I'm not sure the sources are going to change that much. I think there has been a move away from banks and into
already,
into sort of insurance companies, pension funds.
Yeah, and that was a pre-Brexit issue.
That was pre-Brexit, and I suspect that will continue.
Yes.
I'm not sure there is anything that, if you like, directly Brexit related to that, but we shall see.
Okay. And on funding documentation, should treasurers, I mean, we know a lot of treasurers will have been done some preparation, but should they be looking again at their funding documentation? And if so, what should they be looking for?
Well, I think that the key is just to look for things that you might trip over. One of the things that some people will be focused on if they've got a lot of financial covenants that measure, for example, balance sheet items against P&L items, is that a Forex change, as we saw in the last week of June, may well have an impact on that. There are things that people have written into their documents that overcome that. Check whether that is the case for you. Check whether your covenants going forward are affected by things. Check whether things you might do going forward, if your your business is saying to you that you may well want to make some disposals going forward, does your banking documentation allow you to do that? Equally, you may be in the market to make some acquisitions, and again, the same point applies.
And what about MAC clauses? Does Brexit constitute a MAC?
There it is a question of looking at the individual clause.
Yeah.
I have to say, I suspect in very, very many cases, the vote on Brexit 10 days or so ago that will not of itself produce a MAG. The more important point, it seems to me, is the effect of the vote and now the process on your business. Is that changing your business in a way that is material and is materially adverse to the business?
Yes.
That is probably the thing to look most closely at.
Okay. And moving on to disclosure and corporate governance, something that's coming up frequently is the importance of disclosure to markets at this stage of the Brexit process. Stephen, to what extent will corporates have to disclose the impact of Brexit on their business?
I think people are looking at the risk factors. They're looking at, most recent issues have had something in the prospectus that said there was going to be a UK referendum. And now we know the answer to that referendum, so that kind of disclosure needs looking at. Again, however, I come back to the point I made earlier. Look at how Brexit is going to affect your business.
Yeah.
If it is going to affect it, then you may well need to make some disclosure against that, put in some risk factors that relate to that.
Okay, excellent. And Naresh, what changes should treasurers be thinking of in terms of governance, controls and reporting?
Well, I think a lot of organisations are currently recognising is whether their risk framework remains still robust and coherent. So again, part of it comes back to planning. How many organisations had a task force in place? How many organisations had the right people? So some of the things that we've recognised is framework, is it robust enough? Do you have the right people on your task force? And are they asking the right questions?
Are corporates really setting up task force?
We've certainly come across many who have.
Okay.
I guess part of the question remains just how seriously people are prepared for it. I've come across a couple of organisations that had very well-developed plans that identified who would be called to attend the task force, what type of MI would be prepared, how frequently it would be produced, what information would be provided from the market, both in the event of Brexit plus post-event if we trade on Article 50. So I think for some organisations, I'm not sure how many that is.
Yeah.
Certainly some organisations have got well thought through and great plans. Getting the MI right is really important because the risks that organisations face today, the risks that boards have to address today, the prioritisations of those are very different to what they were 2 or 3 weeks ago. So making sure the boards have the right information to make the right judgments is really important. And again, to come back to the point Stephen made, is that it's not that anything has necessarily happened today. The markets have moved. But fundamentally, the legal, the regulatory framework we operate in hasn't changed.
And actually, that won't change when the Article 50 notice is served either. It's a much longer game than that.
Yeah, and so it's really then how do you address what are the risks you currently face? And they do look different.
Yeah, and sorry, just to clarify, MI is management information for those on the call.
The other thing that I think organisations need to reconsider is around their operational risks.
Yeah.
So we know that organisations are going to get distracted, lots going on. We already know that cybercrime and cyber fraud are on the increase. And so really what we're doing is we're pitching a whole range of new risks with things like fraud risk, dealing controls, dealing risk. So again, it's really important to make sure some of those basic things we need to make sure are just as robust today as they were a couple of weeks ago.
And on tax and accounting, do you have a view yet on how Brexit will impact tax and accounting?
Going back to Stephen's point, it's very difficult to say that anything today has changed from where it was a couple of weeks ago. point to my tax colleagues, I think a key area for them to focus on, for corporates to focus on, is really around withholding tax. So for any organisations that start cash pooling, intercompany lending, dividend policy, those are all likely to be impacted. Those may all be impacted if we exit the European Union, some of the current harmonised framework we operate under. So I think for organisations that do have some form of intercompany lending, cash pooling, or dividend policy, it's very important to at least understand what you have today, so that if there are changes that start to come through, you're able to understand and adjust and adapt to those. From an accounting side, first of all, I'll caveat it by saying I'm not an accountant. But looking at some of the information, it's definitely making sure that we address risk and uncertainty. Some of the key areas that I've been told to focus on around IFRS 7, IAS 1, 36, and our old friend IAS 39 as well. So again, nothing really needs to happen today. There are some additional disclosures we need to think about, but it's more around focusing on a watching brief.
Okay, thank you. Okay, moving on to your questions that you're sending in. Thank you, and do keep sending them in. We've got quite a lot of them here, and we'll try and get through as many as possible. Stephen, some questions coming in on passporting. People still trying to understand why, really, is it important? Is passporting important for a corporate? What is it? I think that's the clarification, that people still aren't understanding what it is.
I see. Sorry. The key point is, under the existing EU regime, if you are authorised to carry on a particular kind of business as a bank in one EU country, that is something that enables you to take that authorisation with you and to undertake that business in all of the other countries in the EU.
Okay, so funding, corporate funding, for example. If you fund in Germany as a German bank, you can provide funding to UK corporates.
Yes, so lending money.
Lending money.
From the bank's point of view, yes. So that is the classic example. Now, there are some of those things that banks do, which you are allowed to do in various different EU countries, and you don't need a passport for. So the position is extraordinarily complicated for each bank because they need to look at the kinds of businesses they do in each of the EU countries that they operate in. Coming back to corporates, the question then is, are they able to provide to you, or more particularly perhaps to your subsidiaries in different EU countries, the things that they have been, UK banks, they've been providing to you to date? And conversely, if they're European banks, are they able to provide the things that they have been providing to you in the UK that they have done to date? And the question for all of us is how that is going to change at the point of Brexit. And we don't need to worry about it before then.
Yes, so we've got up to 2 years.
It's up to 2 years to think about that. But that is why I think, again, look closely at your bank, keep closely in with it, and understand what it is doing against that background.
Okay, another question on passporting.
Can I just add to Stephen's point on passporting? I think for those that use insurance companies and asset managers, like banks, they'll also need to think about where, if changes happen to passporting rules, some of those counterparties will change. Some, you may be using them in the UK, they may re-domicile to Ireland or to continental Europe. So those relationships that you currently have may change. So I think part of this whole story is making sure you have communication channels through to your key financial service providers. Understand where they're going, where their thinking is, and make sure it doesn't come as a surprise to you when they suddenly say, we're changing our UK from subsidiary to a branch, or we're actually not providing service in the UK anymore. You want to make sure you're understanding how that flow change.
Okay. The other question that's just come in on passporting, is this the same as equivalence?
No. The equivalence concept is between different jurisdictions. Now, that will come into into play because the UK will be a different jurisdiction from the rest of the EU for many of these purposes. But the concepts there are that I can play with you in a different country, provided you have a regulatory regime that is equivalent to mine. And that is something that the EU has very much focused on, and something that I imagine it will continue to focus on, and of course the UK will continue to focus on going forward, which is why you come back to many of these EU-inspired regimes. We are likely to have something pretty similar, frankly, after the 2 years are over, in order to achieve equivalence.
Okay, excellent. And Stephen, you touched on this before. One question, will Brexit have any repercussions for EMEA regulations? And coming out of that, there's a few questions that have come in. Will reporting obligations under EMEA cease? You can see some treasurers out there wanting to get rid of EMEA reporting.
Yes, that would be great, wouldn't it? It's, particularly for your intergroup stuff. I mean, again, the answer is nothing yet.
Nothing yet.
So wait until we get to the end of the negotiating period, whenever that will be. It might be that the UK then introduces an EMEA type regime that doesn't have that kind of onerous aspect to it.
Yes.
Or it might not, but I'm afraid we just have to wait and see.
So the treasurers out there, you still have to keep reporting, unfortunately. Here's an interesting one. Can we still borrow from the EIB?
The EIB is only able to lend to companies within the EU. So there is a question.
So for the next 2 years?
For the next 2 years, and actually the EIB has already been introducing into its facility agreements some sort of Brexit type break. So those of you who funded from the EIB some time ago, I suspect you probably don't have that kind of clause. But those of you who have been in the last couple of months will have it. And so that is an issue. It's particularly an issue for utilities companies in the UK, which have actually taken quite a lot of EIB funding, and will be something that I know that they will be concentrating on.
And will those that have already borrowed from them have to repay?
Well, again, you need to look at your loan agreement terms and just see what they say. And as I said earlier, some of the more recent ones may well have a break in.
Okay. Naresh, one of the questions is, sorry, I'm just reading it. You said you expected to see significant reduction in cash balances in the future. Why do you think this?
I think it's a possibility. I think as we move back to a risk-averse environment, every company is going to want to hoard cash for I don't know what circumstance. What it's going to mean is for customers, they're going to want to pay more slowly, and suppliers are going to want to get paid very quickly. So I'm not sure it's an eventuality, but I think it's something people need to be mindful and aware of. And I think it's a real risk. So it's really around monitoring their cash flow forecasts and customer supply behaviours.
Another question, is there potential for the UK to be pushed out of CEPA? Naresh, question. It's a difficult one at this stage, isn't it? Goodness.
We did say earlier
there may be some questions we can't answer, and you know what? I think that falls into that bucket. I don't have a view on that, whether we be pushed out of CEPA. We'll park that to one side and give that some further thought.
We have a sort of interesting association in terms of implementing aspects of CEPA.
Yes.
What's very clear, if you look at things for something like PSD2, we are still covered under EU law to implement PSD2 or the other regulations until the negotiating period is finished.
Yes.
So for any corporate who thinks they can, we don't need to worry about some of those things. Fortunately, that's not the case. And who knows, even if we do leave, we may still decide we want to absorb a lot of what PSD2 is trying to implement.
Okay. And that's Payment Services Directive, for those on the call. Another question, will there be a significant long-term impact on hedging costs? Naresh, any thoughts on that? It's an interesting question. I mean, short term, you mentioned that you'd seen a widening of spreads in the FX, but any long-term impact on hedging costs?
Well, it's very early to say what's going to happen in the long term. I think that it's an interesting time of market because you've got the traditional banks, you've got a lot of fintech banks all now starting to enter into this market. So we've got, to some extent, a different playing field for FX risk management. Will the cost of hedging go up? You could argue fintech is helping to drive costs down. So I think that we'll see more non-financial intermediaries providing FX facilities.
Yeah.
Greater risk, greater choice for a lot of corporates. And I think that some of those traditional, things like cable, sterling, euro, they'll remain highly liquid and for many corporates, very low cost transactions. As corporates start to look further afield and may start to look at more emerging market risk, then they may see an increase in hedging costs just because those are generally less liquid.
Okay. How much will the UK SME be impacted? It's a very broad question, that's come in, but small to medium-sized enterprises. Any thoughts on that? I mean, there's some obvious ones that you've mentioned on, if they're importers or exporters, they'll be impacted through FX volatility and the weakness in the sterling. Anything specifically in your points that relate to SMEs?
Well, I think it really depends on the business. So if we believe that this could actually open up new opportunities for UK industry, for the small and medium-sized enterprises, it's a great opportunity for the businesses themselves to explore new markets for goods and services. And if that's the case, then for treasuries, it's going to be quite an interesting place to operate in. There is no doubt, there was an article yesterday, I think, in the BBC News, a lady who runs a hovercraft factory in Kent has been inundated with requests for quotes because of the depreciation of sterling. So we definitely see that for small and medium-sized enterprises, a real opportunity to grasp the opportunity of sterling depreciation and look at export markets to grow their businesses. And for them, it's a great opportunity for Treasury to help support.
Okay.
The other point, from a sort of legal point of view, there has been a move to give SMEs a less complicated regulatory environment in EU legislation, but it's also been a move by the UK government as well.
Yeah.
I have to say, I would just expect that to continue as a philosophy. How useful it is for individual corporates is a question, but I suspect that's not a Brexit-related question, but rather it's back in the real world and just carrying on business as usual.
Stephen, here's one I think might be for you. What impact do you expect on the Prospectus Directive? And would the UK implement a similar directive?
Interesting questions, those. I think there will need to be some sort of equivalent concept in the UK after we leave. Again, until we leave, there is no change. What form that will take is difficult to see, but it would not surprise me to find that it is a regime that is fairly similar to the one we have at the moment. A question, and I put this more just as a question, will it be the case that the UK will want to be more attractive to people wanting to list out of London than other EU countries? And if so, will it therefore develop a regime that perhaps has a lighter touch in certain areas? I don't know. I'm speculating.
It's an interesting point, actually, isn't it? Because you've seen Osborne reduce corporate tax to try and make the UK more attractive, and we might see it in other areas.
I think that's what we need to focus on.
Okay. Employment. A few questions coming in on saying UK Treasuries employ a lot of EU nationals. Do you have a view on what will happen? I mean, I know it's not your field, but any thoughts before we move on?
At the moment, I think it is very unclear, but I think there is, notwithstanding Theresa May's desire to put the question off.
Yeah.
I think there is a very strong feeling amongst politicians that people who are already here should remain here. And from at a personal level, that has got to make a huge amount of sense before you even get to the economic points.
Yeah.
So we have to wait and see.
Yeah. Okay.
And just to add to that, certainly from some of the webcasts that I've been listening to on HR, I think one of the real challenges for a lot of organisations will be just trying to pull data on their employees that identifies those that are UK citizens, those that are EU citizens, those that come from outside of both those countries. So I think one of the things I say to treasurers is make sure your HR teams are able to start pulling that data together.
Yeah.
Because again, it depends on what happens, but it's going to be useful.
Yes, go forward.
Okay. So just trying to wrap up here. Could each of you give us, in your opinion, what are the top 3 things treasurers should be doing in the short term? Stephen, if we start with you.
Well, can I just pick up on actually the point that Naresh was making earlier?
Yes.
I think treasurers have to be really agile going forward. And 3 things that really that agility needs to display itself. I think, first of all, keep a close eye on your counterparties. Not just credit, but also look at them in a much wider context. Keep a close eye on your documents, and that's an ongoing process as this fast-moving situation carries on. And the last thing I think is do the things that I think treasurers do so well, which is providing that sort of bedrock of confidence for your colleagues in the rest of the business.
Stay strong.
Stay strong, and I think it will be the case that many of your colleagues elsewhere in the business will be perhaps suffering things a lot more directly than you are, and equally there are opportunities for them as well.
Excellent. Naresh?
3 things I'd say. I think we're in a period of uncertainty at the moment, and this is a great time to actually put your house in order. So drawing on some of Stephen's comments, making sure your documentation is all very clear, you know what it is, whether it's ISDAs, whether it's incoming loan agreements, but making sure you've got it at hand, you understand what may be impacted as the future as we move forward. So within that, making sure your governance is still fit for purpose, your risk appetite is still relevant and appropriate, your contingency plans are robust. If there's one thing most people should have realised by now, is that if this, having seen what happened with the vote, we really have to take contingency planning much more seriously than some of us have done already. We're already helping clients to look at their FX framework, the reporting as well, to making sure it's fit for purpose for the board to make those sensible decisions. And I had a call last week on someone who, for them, this is the straw for them to start thinking about a treasury system, because the volatility, the counterparty risk, the basic Excel spreadsheets are no longer capable of supporting. That's the first thing. Second thing, it's a great opportunity for FX opportunity. So we talked already about how with sterling depreciating businesses, it's a great opportunity to go out there and sell stuff. I've shared already the story about the lady with Hovercraft business. A large continental-based travel company earlier this week said, because of its hedging strategy, it wasn't required to put up prices for its customers. So again, part of what it does is it reinforces how FX hedging and the risk management around it is a really powerful tool. And it's a great opportunity with sterling where it is today. And the third thing, again, I'd echo Stephen's point, for treasurers, this is really a great opportunity for us to show our mettle. We've spent all our time learning about risk management. We sit in a unique place than most organisations, pulling data from across a wide range of different interested parties. Understanding where those risks lie and really helping support and drive the business as it looks at its new challenges with a different lens and perspective.
Excellent. Well, thank you for sending in your many and varied questions. We haven't had a chance to answer all of them, but we'll endeavour to get back to you for those that we haven't had time to answer. If you think of any further questions, don't forget you can get in touch with us in the normal, usual way at technical@treasurers.org. One question that's come in is, can we keep these points on an FAQ document? And yes, we had planned to do that. I'd like to thank my panellists, Stephen Powell and Naresh Agarwal, for their excellent input. Thank you, gentlemen. If you could please take a few minutes to complete the survey, which can be found by clicking the blue widget. Also, just to let you know, a recording of this webinar will be available in the next 2 working days, and there will be a link in the thank you email that you receive in the next day or so. The ACT have a number of upcoming events. One that I will point out there is the ACT African Conference, which I do believe Salter and May are sponsoring. Brexit will be an ongoing story, and the ACT will keep you up to date with new resources, briefing notes, etc., which can be found on our Brexit webpage. And there is an address right at the top of the screen there, treasurers.org/Brexit. So I think the closing remarks, summing up the conversation today, is stay strong and look at this as an opportunity. Thank you.